Hello and welcome back to Technical 101. We're joined once again by Daniela Hathorn, Senior Market Analyst at Capital.com. Daniela, what are we going to be looking at today?
So today we're going to be going back to the indicators. We're looking at the Stochastic Oscillator.
Okay,
It has a very trivial name, but essentially it's a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. And this is a indicator that's used to generate overbought and oversold signals, and it's range bound, so it uses a range from 0 to 100. Surely this is bringing back memories of something else we've done.
Similar to the RSI?
Exactly.
Yes.
So in terms of its uses, pretty much the same as the RSI. It kind of determines, as I said, overbought and oversold instances on a chart. The RSI focused mostly between 70 and 30. Those were the signals.
Okay.
With the stochastic, the general rule is 80 and 20.
Okay.
So that is essentially, one of the main differences. There are other differences, and that is actually how or what they measure.
Yeah.
So, for example, the stochastic is predicated on the assumption that closing prices should move in the same direction as the current trend, whereas the RSI takes overbought and oversold levels by measuring the velocity of price movement. So they are measuring something slightly different, but in terms of the practicality of how you use them, they're very pretty much the same thing.
Okay, cool. Well, should we dive into the chart so I can actually see what it looks like and how different it is to the RSI on the chart?
So this is essentially the chart of cable, which is the pound to the US dollar. As you can see, the normal price.
Yeah.
And then down here, we've got the stochastic. So again, very similar to the RSI. So as you can see here, these are our trigger levels, the 20 and 80 mark. That is oversold, that is overbought. So the stochastic is generally measured over a 14-day period, which is this blue line. But there's a second line within the stochastic. And that's called the slow line. So this is the fast line, the K line it's called, and D is the slow line. And essentially it's a 3-day moving average of that fast line. 3-day because we're on a daily chart if you're looking at another period. So it's a 3-period moving average of that faster line. And what it does is helps to smooth out the chart, really. It helps to smooth out the signal. So if you find it a little bit too confusing to look at them, you can. If you want to look at just one, you can choose to look at just the moving average. So we'd take off the K line and just leave the D line.
Yeah.
There is a way of reading signals within these two lines, so if one crosses above the other. But I think for simplicity in this video, if we look at what the oscillator tells us with relation to price, if we want to just make it easy, we'll just stick to the D line here.
Yeah.
And as you can see, similar to the RSI, we're looking at levels where the stochastic is crossed below or above the 20 or 80 line.
Yeah, and I imagine, so for context, today we've just had the Bank of England rate announcement. They didn't hike rates, and yesterday there was some hawkish sounds from the Fed, and so the pound has sold off against the dollar. And so, but right now, is it showing that it's technically oversold?
Correct. Yeah. So you can see we've come from a period of selling already in the past, pretty much since the highs that we saw back here in mid-July. It's been a downtrend. We have seen a few reversals along the way, which has allowed, in those instances, the stochastic to come back from that oversold. So a lot of the time, once the stochastic, as you can see here, was coming into oversold, we did see a little bit of a reversal. Minimal. It was only a 2-period or 2-day reversal before heading lower again. But if you were a trader that uses stochastic as an indicator, here you might have said, okay, it's been a little bit oversold now for a few sessions. I'm just going to put in a buy trade with a trigger around this level. And then you would have potentially ridden out this reversal higher before closing out. Again, closing out that reversal may have been a little bit harder because you can see it only came back to 33 before turning lower again. So sometimes, or the hardest part about trading, I say a lot of times, is not the direction, but the timing.
Yeah.
So it might be a little bit tricky to know when to close out the trade, but it definitely works in some instances. You can see similar here, we were oversold on the stochastic. We saw a little bit of a rebound here, 1 period, but again, if you're trading intraday or you're trading shorter time frames, you would have taken this potentially as a signal to come in as a buyer. We're now oversold. Another way to look at this is, okay, we are now the most oversold we've been since, you'll have to wind back in the chart here, but potentially with the most oversold we've been since March last year or November 2021. And then you can look at the price chart and see what was happening the last time we were there as well. So it's not only using the stochastic on its own, but it's looking at the relation to price as well.
Yeah, and again, marrying the fundamentals with the technicals, what's going on in the world around you, why is it doing that?
Correct.
Is it oversold because there's something big going on in the market? And then kind of combining them with all that information to make your trade.
And I don't know if you remember when we were looking at the RSI, there's something called RSI Divergence or convergence. And the divergence is very often used to trade. So for example, let's say the price is telling you that it's a bearish pattern, so you've got lower highs in price, but you've seen that turn in the stochastic. So instead of seeing let's say for example that this high here was actually higher than this one, when on the price it's lower, then essentially you would take that as a signal that a reversal is coming and that it could turn higher. We could try and find one on the chart, but similar to the RSI, you're looking at that divergence between price and the oscillator, and that usually tells you that a reversal may be coming, whether it's to the top side or downside, whichever way you're reading this. So it's very, very, very similar. If you want, we can actually pull up the RSI to compare.
Yeah. Would you ever use the RSI and the stochastic in conjunction with each other on the same chart?
You can, yeah. As I said, they measure different things, so you can use it. And for example, one may be more sensitive to the other. So for example, if we're looking at the last, the last 4 or 5 months, we've seen that the stochastic has actually dipped below the oversold area, 1, 2, 3, 4, 5 times, whereas the RSI has only dipped just now. So you may be using, I will only take this as a sign that we're really overbought if both the stochastic and the RSI have gone into oversold territory. They give a very similar vibe in the sense that they're telling you whether an asset is oversold or overbought. But essentially, it's pretty different, and they measure different things, and therefore they will give you different signals. So again, as I always say, you can't really use an indicator or a chart pattern in isolation. You've got to see what the whole picture is telling you and what is the fundamental tell you. And if you're strictly a technical trader, that's fine, but usually at least use 2 or 3 other to make sure that you're getting the full picture, because a lot of the times, and I know you're going to ask me this, what is one of the main drawbacks of the stochastic? I'm ahead of you. Similar to the RSI is that you can get a lot of false breakouts. And another one, as I said, if you do take the stochastic or the RSI as a trigger to enter a trade, sometimes just using the oscillator, you'll find it hard to know when to exit the trade. So that's probably one of the key drawbacks.
Okay, cool. And then what is the kind of, because I've tried the RSI when I've been playing around on the charts, and when I change to a different time scale on the charts, the RSI seems to change. What are the differences between the time scales?
So usually on a shorter time frame, it's going to be more sensitive. Because you're reducing the amount of data in the sense that you're just shortening the time period, and usually indicators become a lot more sensitive in shorter time frames. So I think you've got to be, you make sure that you're not being biased in that sense, and that you're reading it correctly. And for intraday trading, maybe the stochastic and the RSI aren't the most used because, as I said, they produce a lot of false signals. And I mean, we can try and go into like a 5-minute chart and see what it tells us. But if you're looking at this on a 5-minute within the last...
So then it's saying it's overbought.
Yeah, exactly, right? And that is essentially because we had such a big drop on the back of the Bank of England meeting that the way it's moved since then on a 5-minute chart, it's looking like it's overbought. So again, you've just got to make sure that when you're reading these things, you know what time frame you're looking at and what exactly it's measuring.
And the time frame has to work in context with what's going on in the market,
so if you've got a 14-day period, stochastic or RSI, in a chart it's 14 days. In this, it's 14 5-minute periods. So you can tell, you've gone from measuring 2 weeks of data to measuring a space of just a few hours. So it's going to be very influenced by that.
Great, okay. I mean, that's made kind of perfect sense. And knowing what the RSI was before has made it much easier to understand. So, I think I've actually got that one. So hopefully viewing at home, that's made it make sense for you as well. That's the Stochastic Oscillator. Yeah. So don't forget to like, comment, and subscribe. And yeah, we'll be doing more of these in the future.